Most financial assets remain down double digits percentage-wise versus the start of the year. There are growing signs that the red-hot housing market is fast cooling too. And it's hard to make the case that prices will pick back up again soon, given that the Federal Reserve remains fully focused on destroying demand in order to bring today's hot inflation under control. So will the pain in the markets get even worse from here? Are we hurtling towards a stagflationary recession? Well, for an informed perspective, we're fortunate to be joined by macro analyst Lyn Alden, who's just returned from speaking at an international conference in Norway and is speaking to us despite having just come down with COVID. Lyn, thank you so much for joining us today.
Thanks for having me. Happy to be here.
All right, Lyn. Well, look, thanks so much for doing this. I'll try to get through this as quickly as possible, but I did make the error of asking my audience in advance what questions they would like me to ask you, and I ended up getting thousands. So we're just going to crunch our way through it as best we can. But before I get to the questions, the specific questions, let me kick this off with a general question I always ask you when you come on, which is, what is your current assessment of today's global economy and financial markets?
So I think the underlying problem is that we've underinvested in a number of real world systems, right? So commodities, especially energy, as well as we've highly diversified our supply chains globally. Basically, we've optimized for efficiency over resilience, and we're kind of getting the call on that setup, right? So we're kind of quickly finding out the world's not quite as peaceful as we thought it was. And that if we underinvest in some of these natural resources, we're going to be short them when the time comes. And so we have these real world constraints, and combined with the fact that we increased our currency supply by quite a bit, we've run into inflationary problems. And the Federal Reserve and other central banks can't print more of those real goods and services, but they can try to curtail demand. And so right now they're doing the best attempt to jawbone demand lower, while trying also to avoid an outright recession. And historically, the Fed's ability to do soft landings is not very high. It's a very kind of low, maybe a couple times they almost did it, but for the most part, it's like an on or off switch. And so right now, I would say we're basically going into a economic deceleration in an otherwise stagflationary environment. And so I think this is a rather defensive. You generally want to be more defensive at this time and focus on things that have real world utility.
All right. Actually, excellently succinct summary. So we sort of have more currency units, chasing fewer things, and I'm saying fewer things because we are having some big supply chain shortages still lingering, and so to deal with that, because the central banks can't print up more real things, they're trying to drain the pool a little bit to get the inflation under control. You said we're going into an economic deceleration, into a stagflationary environment. I think I got that correct. And I'm just curious, we'll get into this in the specific questions in a second, but stagflation is when inflation remains hot, but economic growth gets stagnant. If you think we're hitting into a period of stagflation, how long do you think it will be? In other words, how long does it take for stagflation just to become recession, because finally demand destruction begins to bring the inflationary prices down, but you're stuck with the stagnant economic growth?
Partly that will depend on policymaker decisions. But for example, if you go look at the 70s, even during the economic slowdowns, the recessions in the 70s, you still generally had pretty high inflation. You just had, maybe you took the edge off inflation compared to some of the most inflationary periods. And so my general view is that this whole decade is probably going to be somewhat stagflationary. Basically, we're going to have supply side problems, particularly on the energy side, I think, for quite a while, for years at least. And whether or not we, bring inflation down, so let's say official CPI down to 6%, 5%, 3%, depending on how low we go, that partially depends on how forceful central bankers are willing to be and how to what extent politicians are able to deal with recessionary conditions. Because right now, the clear, if you ask people out there, what is the biggest problem, they'll say inflation. And right now we're starting to see kind of a slight uptick in initial jobless claims. And so I think, to the extent that they try to continue tightening by pulling back on stimulus and tightening monetary policy, I think we're going to see a shift towards a weaker job market. And you kind of can turn an inflationary problem into an unemployment problem. But you can also have both at the same time. And so I think that there are scenarios where they could cause like some sort of deflationary bust temporarily. Like you could kind of, cause a severe contraction. But I think that unless they push it that far, I think we're in more of this kind of malaise where, energy prices are high, they're kind of the constraint. And they can be in a big choppy range if you're really trying to hold demand down, but it's like holding a volleyball underwater, right? It's, holding a beach ball underwater. And so I think that, I think I would use the analogy that we're kind of rounding a corner going very quickly, where we see the long run where we're going, which I think is much higher energy prices, much higher inflation. But right now you have to kind of put the brakes on and slow down and be careful with your investing around this corner, because this is the period where central banks are trying to fight back. And so for the next at least several months, as long as we're, going to experience quantitative tightening, raising rates, and, no new stimulus from Congress and things like that, I think it pays to be defensive around the margin and to look towards maybe some degree of disinflation. Not necessarily that inflation will go away, but that we might not keep going up at the same pace that we were, at least that, especially outside of energy. And so that's how I play this. Basically, I think that we can almost have a barbell approach where you stick with energy types of investments, but then you also look at some of the more defensive types of things like cash and even treasury bonds.
All right, great. I'm writing this down so we can revisit it later on. Um, I said a couple of times a month or two ago that the really big question for 2022 really is how big of a backbone does Jerome Powell have, right? Which is essentially what you're saying, where it's really going to come down to central policy at this point in time, which is how much pain are they going to be able to stomach in terms of raising rates here and the impact of bringing demand down. You've referenced the 70s. I want to get to that a little bit more in just a minute, but I agree. It sounds like we could maybe have something similar there, where we had several Fed chairs before Volcker came in with the mandate to break inflation. I think a lot of people kind of forget that there were several predecessors of his that were trying to fight inflation, but they just couldn't stomach bringing the rate up as high as it ultimately took to bring it under control. So do you see something similar here, where we're kind of, Powell and maybe whoever comes after him are going to be, trying to talk tough, but maybe not really have the cojones to do what it's really going to need to be done to tame inflation? So we're going to have persisting inflation and this economic malaise and kind of be in the sort of chop range that you were just talking about?
I think so. And in some ways, it's worse than that because in the 70s, you had very low debt levels. And so at the end of the day, Volcker could raise rates to very high real levels. And it caused a recession, but it didn't cause like a financial crisis, a depression, because you had pretty low debts in the system. So the economy could withstand those higher rates with a slowdown. And before Volcker passed, he even said he couldn't do that today. And it's only gotten worse since then. And so that's one reason I've used the 40s as in many ways a closer comparison than the 70s, because in the 40s you had very high debt levels due to the war and due to things like that. And so despite the fact that they had high inflation, they just had to hold rates low anyway. And so you had a big decoupling between rates and inflation. And we've already seen that play out so far. And so even though they're talking tough, they're still, rates are still below 1%. And so they're moving up pretty slowly, despite the fact that we have multi-decade high inflation. And I think that's a testament to how much debt is in the system. And so I think we're kind of in an environment where inflation is going to be a persistent issue. They're going to try to talk tough, but at the end of the day, the math, matters, right? So for example, if they cause the credit market to become illiquid, if they cause the treasury market to become illiquid, if they, cause an outright recession, we start to see high employment, that makes it very challenging for them to continue doing what they're doing. And so I think they're kind of stuck between a rock and a hard place, and that the release valve ends up being this weird situation where they're unable to keep tightening despite the fact that inflation is much above their target.